Good morning. You're watching us here on Trading Hour on CNBC-TV18. We come to you live from the CNBC-TV18 Motilal Oswal studio. I'm Mangalam Malu. With me, Hormas Vatakia and Ritu Singh, as always, joins in from Bangalore as well. It's not a particularly good day if you are a bull. Yesterday, we saw recovery from the lows at around 25,904, ended above that 26,000 mark as well. There wasn't a big gash on Wall Street overnight, but this morning the market opened lower, and from lower levels, it went further lower, currently below that 25,900 mark as well, slightly below that, so below yesterday's low. The only important level to watch out for on the way down now would be closer to 25,800, where the 50-day moving average comes in. The Nifty fails to cross that 20-day moving average and close above that for the second day in a row. So that's something that we will monitor as we go ahead. Individual stocks as well, broader markets, 2 stocks declining for every stock which is advancing. But despite that, a couple of these names are doing well, and they belong to the erstwhile safe haven securities. So we have FMCG, consumption, doing well. We have a couple of these retailers doing well. And we do have a few of these new players, the likes of Meesho, seeing a big spike. So Meesho is up over 75% now from its issue price. So there is some safe haven buying right now. The market, as we wind down towards the year, is seeing some bit of a sell-off. Hi, Ritu.
Hi, Mangalam. It seems the markets and your wardrobe are perfectly in sync today. Continuing with another day of losses, as you were saying, Nifty now down about 124 points from the day. Sensex about 441 points. So that rough patch for the market, it continues. The market breadth, not much of an improvement. In fact, some worse things since morning. The ratio is 1:1.86 advances to decline ratio. So you have about 1,800 stocks declining on the NSE compared to about 971 that are advancing. All of the major indices are in the red. The FMCG pack is the sole fighter there in the green, still holding on to a bit of a gain in trade here today. So cautious setup, Hormas, but good morning. It's over to you for the specific names that are buzzing in trade today.
Good morning, Ritu. And as you mentioned, the screen does not paint a pretty picture as we wind down on the year. But there are specific stocks in the broader markets that are still holding on to their gains. And a common theme among the names today are the fact that they have been smashed all through the year. And Exicom Telesystems is one such name. It's the fourth straight day of gains for the stock. It's up around 12% today. And it's up 18% in the last 4 trading sessions. It has gained in 5 out of the last 6. Even in today's session, we have had close to 20 lakh shares that have been traded already compared to a 20-day average of just under 2 lakh shares. And the stock is now nearing its 50-day moving average at 128.5. And then you go to the 100 DMA, which is at 138. But the July 2024 peak that the stock had made, well over 500 rupees, the stock is down 76% from those levels. Fertilizer stocks are doing well for themselves today. Fact is one such name. Of course, bear in mind that Fact does not have enough float in the market. It's still the third straight day of gains. The stock is up 7%, is up 12% during these 3 trading sessions. Today's volumes, the highest in 4 months and counting. Here too, close to 20 lakh shares have been traded. The 20-day average is just 23,000 shares. So that explains the very little free float. The stock has moved above its 50 and its 200-day moving average on the upside. And the 100 DMA now comes up at levels of 921. The stock down 8% so far. There's recovering some of those losses, but it might just turn out to be the first negative year that Fact has after 2019. And lastly, Tata Tele, we spoke about this stock last week as well. The stock is now up 10% in today's session. So after that big up move, the stock had a 4-day losing streak, and now it has gained. The stock had gained 18% as we spoke last week. 2.5 crore shares already traded. The 20-day average is just around 26 lakh shares, and the stock is now exactly at its 50-day moving average, which is at 53.6. Now, the positive returns that the stock has had in the month of December comes after 6 months of consecutive losses, and still down 30% so far for the year. And this is turning out to be the 4th straight year of negative returns for the stock.
Right, Hormas, thanks a lot for that. So a bunch of stocks which are moving around right now, but Supreme Industries, that's recovered to the high point. We have Astral as well. So a couple of these pipe players doing extremely well. And we've also seen some traction in a few names that come from the broader market, cash market names in particular. Nava, for instance, has recovered from the lows, decent volumes backing that one. And Thyrocare, that's the one that should come up for you. It's a big move that we're seeing on Thyrocare, from lows up around 4.5%, currently sitting with a gain of about 3.5% at the high point. Take a short break, come back, focus on the commodity space, bond market with Manisha Gupta on the other side.
Welcome back. Still 130 points lower on the index. Still fighting tooth and nail are the bulls to defend the 25,900 mark. But the bigger talking point is the currency. Another record low, 90.91 against the dollar is where the rupee has declined to. We'll get to that in just a bit. But shifting focus to the bond markets now, Manisha is here with all the latest from that space. Manisha.
Thank you for that, Hormuz. Well, absolutely. The bonds also are taking cues from the Indian rupee, and the way the rupee seems to be declining is quite heavy on the markets right now. So this is the worst year that we're looking at in sense of the currency since 2022. It has been about portfolio outflows, delay in trade deal between the US and India, and the markets believe that the lower RBI intervention is yet another thing to blame, because we are looking at a very sharp decline coming in for the currency, and we've been telling you this it perhaps is the worst performing currency in Asia when you look at this current year. A very, very sharp decline coming in for the currency. The bond markets also reacting to this. Well, the central banks' debt purchase is one thing that the street is watching out for. And the other thing has been about the foreign investors' activity that the street will keep an eye on. If you look at the 10-year benchmark, well, we have seen it gain quite strongly. The yields, that is, the most in last 4 months in the previous week itself. But the bonds also have seen a bit of a decline, because you have seen that heavy selling pressure come in from foreign buyers. It also has been a sharp spike that we've seen in overnight index swap rates that have led to offshore paying interest there. When you look at the overall markets, well, the central bank's upcoming bond purchases is something that is in focus. The traders do expect that the yield will continue to be between 6.5 to 6.65 there. Well, it is the previous week, that is, then when RBI really bought quite strongly into the markets at around $500 billion at higher than expected cutoff prices in the previous week also. Well, there has been selling that we've seen come in from portfolio buyers, the portfolio investors ahead of the year end into the foreign markets there. So when you look at the overall number there, the year-end selling pressure that you have seen clearly seems to be the case. In the first fortnight of December, we've seen net sales from foreign investors at 54 billion, while the foreign banks in the same time period have sold something like 30 billion as well.
Address Rupee.
Oh, Manisha, thank you for that update there. And speaking of the currency, it's the new low that the rupee has now made, 90.91 against the US dollar, and continuing to make fresh lows. This is despite the fact that India's November trade deficit had declined sharply, primarily because the exports grew very strongly by 19%. Now, exports to the US, in fact, have also increased. Lata is now here for her editor's take on the fall in the currency today. Lata.
Yes, another day, another low for the rupee. It now looks like it is importers who are panicking. That's what dealers tell us. The scene from the Reserve Bank appears to be let it find its own level. They are apparently in the market, but not really trying to protect any level. But the importers finding that, the rupee is going well into the 91 area are panicking, and we are seeing, at least dealers say, that they are coming and buying in a hurry. They were not prepared for a level above 90 to the dollar, simply because for so many years now the average fall, depreciation of the rupee versus the dollar has been 3%. And now it is 3% since mid-November itself, which clearly importers were not prepared for. And that's why you're seeing this, elevated rise in purchases of dollars. The other important point is that although we have got a very small trade deficit, monthly trade deficit in November, that is in the current account. In the capital account, we are continuing to see huge outflows day after day. It is anything between a 1,500 crore to a 4,000 crore sell by FPIs, big, organizations like Prudential and earlier LG, Hyundai, all of them wanting to exit. So FDI and FPI are exiting. The fact that there is a narrow trade deficit is not mattering to the market, because these people are exerting pressure. You must note that in a day like today, when trade data is good, the dollar index has fallen, crude is at $60. In spite of it, the market is not taking any encouragement. There are no positives for the rupee long guys, simply because, there is no support. There is no two views in the market. There is no supply of dollars. It is this FPI, relentless FPI selling that is countering all these positives for the FX market.
Right, Lata, thanks a lot for that. But, what is this reluctance of the RBI for it to let it fall the way it is? I mean, at some point, it would have perhaps come in.
I think that's what they tried earlier.
Okay.
And it didn't work. I mean, if the pressure of FPI selling is so huge, $17 billion and counting, as far as only FPI exit is concerned. And now even the bond guys are selling. Bonds were 8 billion positive in this year to date. But last few days we have seen them also selling because the currency is not helping. Every day they see their profits evaporating. So that group has also started selling. Now, if you come and try, you can't really bet against the market. You have to ensure that the FPIs find Indian markets attractive. There is no other way to solve this problem. Why would you want to let them get out at a better rate? Let them pay the market rate when they are leaving. Beyond a point, no central bank can stand against the force of the market. They can do it for a day or two.
Yeah.
They can do it for a week, perhaps. But you can't literally
reverse it. They just want
you
to
can't
soften
reverse, when kind of the world is against you.
All right, we have Ritu with us as well. Ritu, you have a point?
Well, Lata. Well, yes, actually, Mangalam, we have Dheeraj Nim, who's an economist and, FX strategist at ANZ Research joining in now. So, Lata, we'll thank you. But Dheeraj, very quickly, Rupee, new day, new low, 990 and, falling swiftly towards 91. The trade deficit numbers were better than, many expected. And even then, the Rupee doesn't seem to be finding any support. What are the immediate triggers and what is the near-term target that you have?
Thank you. Thank you for inviting me. Look, I think it's more of the same story these days. Nothing much perhaps has changed in the overall risk matrix that the Indian economy is facing as long as the U.S. tariffs remain. And what we have seen in the last few weeks is a lot of surge in importer hedging demand because of these one-sided expectations on the exchange rate. And that perhaps is still playing out. So after yesterday's trade deficit number, I do think, however, there is some scope to heave a sigh of relief because not only the trade deficit was better than expected, but even if you seasonally adjust it, it was even lower at about $22 billion, perhaps reflecting that the risk is not as large as we had made it out to be. Of course, we will need a few more months of data to confirm that. But I do think that, the current momentum can sustain a bit because the market expectations are one-sided. We, in fact, have our, USD INR forecast at 91.5 by the end of next fiscal, which would appear much sooner in the market. But there is, of course, some leeway here for the central bank as long as dollar remains weak and, the trade deficit numbers have improved a bit, that some of these pressures can abate. But we'll have to, of course, watch out for the next few sessions.
And what are the immediate triggers then in that case that you'll watch out for? I mean, this trade deal, we're still awaiting to hear more on that front. The deficit numbers don't seem to be helping much. RBI seems to have had a hands-off approach, perhaps, for the exporters to also benefit in light of what's happening around us. So what are the immediate triggers when you say this 90.5 we may get to before the end of the fiscal itself?
Look, I believe that there is no specific event trigger apart from the U.S. trade deal, which we don't know when it will happen. But I think at these levels, we should become a little careful about the RBI's intervention, which so far had been a bit hands-off. They're letting the rupee sort of play out to the market forces, only smoothening the slide. But if the broader economic complex is pointing to risks not being as large as market is imagining, then it may happen that the RBI could intervene a little more strongly to sort of manage expectations around the exchange rate. Look, it has not let the rupee have a free run, in terms of depreciation. I mean, it's still controlling the slide, but letting the market forces play out. But if the economy so warrants or the evolving configuration of the economy so warrants, they may come in at some level, perhaps around in the 91.5 range to sort of signal that they may not be comfortable for the rupee to depreciate even more. So I think we should watch out for some strong-handed intervention from the RBI, especially relative to the recent few weeks where they have been a bit hands-off.
Okay. Two-part question, Dheeraj. Do you think that when we get to the Jan-Feb-March quarter, where we clearly post a trade surplus, usually, in several years in the past, and now the way in which the November exports have trended 20% higher, if we get a surplus in March, in the March quarter, do you think the rupee automatically will find a floor because the demand from importers is less?
I do think, Lata, that could be a possibility, but here's a two-part story again. So we have the financial account story and the current account story. Let's be honest, the current account story has worsened a bit, but it's not become unmanageable, so to speak. I mean, the pressures from the current account perspective, even over November, were not particularly sharp when you go by the aggregate trade data. So I think what will happen in the financial account is also very important, which is where I think that if at all the central bank gets a little uncomfortable around the levels at which the rupee is trading despite improved trade numbers, there could be a bit of an intervention which could be slightly stronger than what we have seen in the recent past.
Is anyone, Dheeraj, talking about a policy intervention? Do you think we have to come to terms with the fact that FPIs are not entering and maybe make it attractive to them by removing withholding tax or any tax on them? They often complain that this is the only country which taxes their gains.
Well, to be honest, I haven't heard any chatter about taxation sort of relaxation for foreign investors. At this moment, we're all treating these outflows as hot money outflows. Of course, they have persisted for a bit longer than we would have liked, but we're hoping that at some point India's strong economic fundamentals will come back into play, especially when the clarity over U.S. trade deal emerges. The sentiment can reverse dramatically. So I think that hope is still very much alive.
All right, we take that point. Dheeraj, thank you so much for that. Thank you, Lata, for
I don't think it's hot money. It's prudential going. I mean, they've been here for 2 decades.
Let's see how that goes, Lata. We'll monitor this and let's see whether if it falls a little too much, does the hot money come back and stems that fall or not, even if prudential is going for now. Take a short break. Come back. We will get you a special discussion on IPOs. In fact, all that we've lined up on the show today invariably somehow comes back to money. How is that? IPOs, if foreigners are selling, then maybe that could impact the flows out there. And at the same time, if FPIs are buying into those IPOs, that could negate that. And the second part, after that, we will discuss hospitality, because the foreign tourists so far haven't come in the numbers that we expected them to. Whether they come back or not, and whether that gives us some foreign currency or not as well, is something we'll be tracking. Take that break, come back. Pranav Haldia joins in.
Welcome back. You're watching Trading Hour. Now we'll shift focus to the primary markets, where it's been a record IPO year. About 102 issuances so far, raising about 1.75 lakh crores, surpassing the highs of the previous few years. We have Pranav Haldia, MD of Prime Database, joining us now to decode some of that primary market action. Pranav, welcome to the show. Thanks for your time here. Just looking at some of the data you provided us from Prime Database, in 2025, the OFS has crossed about 1.1 lakh crores versus the fresh issuance of 64,000 odd crores. Should investors be worried that, the promoters and these PE funds are selling more than companies are investing? And is there any clear correlation you see in your data, between these lower OFS heavy IPOs and better post-listing stock performances?
Good morning, and thank you for having me. Yes, it's been a record year, and before I get into the OFS bit, I would like to say that this is actually the first time in India's IPO history that you've had 2 back-to-back all-time high years. Traditionally, you've always seen that all-time high year is succeeded by a couple of years of relative calm, but you've had record fundraising in 2024 and now again in 2025. Now, coming to your question about OFS, of course, that's something which has, structurally changed in the Indian IPO market over the last 30, 40 years. Just looking at the data, if I look at the data of 24-year period from 1989 till 2012, during that time, just 13% of the amount was actually raised through off of sale. While over the last 13 years, since 2013, 68% has been raised as offer for sale. So it's been a big change. A couple of points which I'd like to make. One is that, fresh capital being raised is not particularly or necessarily a good thing. This period which I spoke of from 1989 till 2012, where a lot of fresh capital was raised, most of those companies either shut shop as their business models did not work or vanished. So what you used to see back in the day was companies used to come to the IPO market much earlier in their life cycle to raise the risk capital or the growth capital. What has structurally changed in the Indian capital market over the last 10, 15 years is that risk capital is now being provided by angel investors, venture capital, private equity, And only companies which are able to reach a certain scale, a certain size, establish some governance mechanisms, come to the IPO market. So in my view, this is a sign of a maturing capital market ecosystem. This is also very akin to what you see in the Western markets, where typically by the time the company comes out with an IPO, the founder is left with single digit of holding. We should also acknowledge that these VC investors do need to get an exit, because only if they are able to return money to their investors will they be able to raise the next set of funds to invest in the next set of growing companies in India.
No, we take that point entirely, Pranav. It makes entire sense to not, look at IPOs, whether they're good or bad, whether it's a fresh issue or it's an offer for sale. That point well taken. The question here is that if it's an offer for sale, typically it's about the value that is left on the table. If a company comes much earlier in its, growth journey, the riskier capital, there is a lot of growth ahead of them, and as a result of which higher valuations the street would have liked because they were novel businesses. But now the VCs and PEs are investing in these companies at extremely high valuations, juicing most the value out, and thereafter, in a way, so to say, dumping that paper on public at a much higher valuation for their returns, when growth or most of growth is perhaps behind the company. So it's the quality factor as against, whether the paper comes from the promoter, the PE investor, or whether it goes back into the company for growth. So that's something that is, a bigger function of how returns are. So I wanted to ask you on that itself, on the database that you have, how many of these issues that have come by have done well on listing day, 6 months from listing day, and 1 year from listing day? Do you have any data on that?
Yes. So, to answer your first part, market is all about risk and reward. So surely we can have, companies coming at an earlier stage to the public market, but then we should remember that, that would, result basically be more risky investments as well as far as retail investors are concerned. And that is what you saw in the past as well. Now, coming to the data, I'm not a big proponent of doing this post-analysis, whether 6 months or 1 month later, or 1 year later, or 2 years later, because I do believe that after a company gets listed, its share price will go up and down on the basis of its own performance, how the sector is doing, how the economy is doing. Nevertheless, we did do some analysis, and we looked at some data from 2015 onward, which is the last 11 odd years. And actually, it was startling. The findings were extremely surprising that out of the 103 pure OFS IPOs which have come, they delivered an average of 351% return, while the 81 pure fresh capital IPOs delivered half, or 173%. So actually, even from a return point of view, and in fact, I often give this example of India's largest IPO, which happened last year, of Hyundai, which was a complete OFS and has given a good double-digit return. Yes.
Well, Pranav, sorry to cut you short. We have a lot more questions, but we have some breaking news coming in, so we'll have to thank you for now. The rupee, it has crossed the 91 mark now. If 90 was a sentimental level, 91 is going to rattle people on the street. It's a new low. We started the day with about 90.80, and now swiftly the rupee has moved to 90.91. That is the level to take note of. Not much has changed in the broader market as far as the sentiment is concerned. The continued FPI selling has weighed on the rupee. The fact that the US trade deal, is taking longer than perhaps was expected, that continues to weigh negatively on the sentiments. It's not helped by the fact that we had a better than expected, trade data coming in. So taking all of that into account, some of the experts we were just speaking to expected the rupee to touch this level, in the next few weeks. But we've already seen this 91 level being crossed. The RBI at least has been, more or less hands off, not really coming in to supply dollars in huge amounts, the likes of what we'd seen perhaps last year. So there is a gradual fall that RBI has allowed, and now we have the rupee at 91. And so we're going to wait for some reactions on, what this means. We're trying to reach out to some of the experts. In the meantime, just take a look at the rupee, down by more than 5% this year. Easily the worst performing Asian currency in the market. But, as we wait for more reactions on that, we're going to slip into a short break. But don't go anywhere. We'll be back in just a moment to take this forward. Welcome back here with the Trading Hour, and we've been talking about the rupee, which has now breached a fresh record low 91 against the greenback. And we have Navneet Damani, the head of commodity and currency research at Motilal Oswal Financial Services, joining in now. Navneet, thanks very much for being here. You know, this 91 mark, a new psychological level. Do you see some consolidation here, or do you think this could trigger, some further momentum? And what are you immediately hearing from traders? Is there some panic buying from importers that's triggering this fall?
Well, 89 was a psychological level which was not surpassed for a very long time. But ever since that's breached, a panic selling has been set in, and we are seeing depreciation every alternate day in the rupee. Primarily, exporters have been very active in the market and have been covering to a very large extent in anticipation that probably there might be a peak around 91, 92 levels. In anticipation to that, trade deal has been a major laggard, which has been adding to the depreciation at this point in time. Until we hear a positive buzz from the government as far as trade deal is concerned, or probably some intervention, massive intervention from the RBI, then the slide is likely to continue. And technically speaking, it's headed towards 91.5, 92 levels before we take a break.
91.5 and 92, that would be fairly scary. I mean, 91 isn't any less scary either. Navneet, I just wanted one, clarity. How are the volumes right now? Is it falling more on lower volumes, or is it volume back? Because towards the end, the impact cost increases as well as volumes thin out across the world.
Well, I wouldn't say the volume is very consistent. It's been ad hoc on alternate days and alternate time frame. As and when we approach a new level, we see massive amount of volume come in. But through the day, the volumes are not as robust as it was around 87, 88 levels.
Navneet, generally the depreciation in the rupee is coinciding with a strength in the dollar. In this case, that's not the case, right? Because the dollar is struggling. It's still, sub 99. It's almost at 98 now, the dollar index. So what other external factors, barring the trade deal, is contributing to this? And if you mentioned that 92 is where you take a break, does that spark an intervention from the RBI, which has so far remained absent?
Dollar and rupee have not been in sync ever since start of 2025. We saw dollar appreciating, or dollar index falling from 107 levels to 96 and then appreciating back towards 100. But pretty much around that level, the rupee was consolidating between 80 to 83 levels. They did not react to it. Ever since the dollar started to go flat and probably rebound from 100 to in the range of 98, we are seeing a depreciation in the rupee. Largely, the driving factor at this point in is the trade deal and the capital flight, which we're seeing in the equity markets. To top it up, the Japanese bond yield has been rising. U.S. bond yields are upwards of 4%, and the differential between both the countries is something that is kind of having upper hand on the rupee at this point in time. RBI will come to intervene or not is somebody's guess. They were pretty active in the market between 88 and 89, but ever since that, we've not seen a massive intervention from the RBI. And 92 is a level where I think we see that some bit of exuberance or some bit of depreciation might take a pause. We've done an analysis of the last 40 years where rupee tends to depreciate by say 12% on average in every 4-year bracket. And since 2023 to now, we are depreciating by about 9.5-10% as we speak. So another 1.5-2% is still on cards. It happens by end of the year or maybe start of 2026. We'll have to wait and watch.
Navneet, just very briefly, the RBI's $5 billion forex swap, immediately in the spot market, do you think that could have any very, very short-term trigger?
That is already in the price. That has been announced about a week or so ago, and that is already built in the price. And the forex reserve is something that we have to wait and watch for, because they have not burnt much of forex reserves. We were around 702 at peak, and as of last week we were around 686. So this typically indicates that RBI actively is not intervening in the forex market at this point in time, because if that happens, then forex reserves go down very drastically and very rapidly. So we'll have to wait and watch. The Fed or the swap that you're talking about is already built in the price.
All right, we'll leave it at that, Navneet. Thanks very much for your time here. We have to take a short break, but don't go anywhere. A discussion on the hospitality sector when we return.
Well, as we move towards the end of this year, an interesting set of things that we'll be watching out for the hospitality sector in particular. On the one hand, rupee being so, weak as against dollars, international holidays perhaps for a lot of them out of the way. Do they celebrate in India itself? Second part, there are more weddings in the second half this year than there were same time last year. So will that help the, a MICE business of all these hospitality companies? And finally, we have this emerging group of affordable premium hotels which have come in as well. Would that be the next leg of growth coming in for all these companies? Well, we have an interesting discussion lined up. Nikhil Sharma of Radisson Hotels joins in, and alongside that we have Chandar K. Balji, the managing director at Royal Orchid as well. Nikhil, thank you so much for joining in. Mr. Balji, thank you for joining in as well. The first obvious question, the industry did near double-digit growth in the first half of this year. There were a lot of disruptions. The second half, analysts are penciling in, 15% plus growth and a higher EBITDA growth as well. Does that continue despite the disruptions with Indigo?
This disruption with Indigo is just a temporary phenomena. And I think we are used to in the industry some disruption or the other. Like the first quarter, there was this war which is going on. Then second quarter, there was this rain, disruption by rain. So we have to get used to all this, and carry on business regardless of this various disruption. We don't know what is in store in the future, but I think there's nothing like COVID which is happening, hopefully, and so we are prepared for all that.
Nikhil?
Hello, firstly, thanks for having me. Despite headwinds in Q2, Q3, 2025 has closed and will close at a strong and healthy. Let me just put that in first. It's been led by rate and not by occupancy. What do I mean by that? We've seen ADRs go up by 10 to 12% in peak months, RevPARs up in low teens, and demand, like you said, was driven by corporate, MICE, weddings, and if I can say festive leisure, because November was a month without any festival, and it gave us a clear base. And the last piece is that you're seeing India's growth in tier 2, tier 3, tier 4 markets away from the metros. So really the demand base has broadened.
Well, Nikhil, your target for the next year is to get to about 150 operating hotels. But how confident are you about maintaining pricing power as the supply expands, especially in, the non-metro markets? Are you seeing greater competition on room rates?
Let me just say, Ritu, that there may be some micro markets that may see stress, but let's just take Bangalore as a micro. Instead of Bangalore, Mr. Panji is based there. I think it's a well-weather market. It's seen a 20 to 23% increase this year over last year. We see corporate tech and MICE-driven growing further in that market. And for 2026, I see even the micro markets within Bangalore growing at least a 6 to 7%. And if you talk about non-metros, you will see similar growth patterns, including leisure, whether it's Jaipur, Goa, or Udaipur. They are now stable and growing at a great pace.
Right. Mr. Balji, I'm curious to know how the opening of the Navi Mumbai airport would impact pricing in hotels which are closer to the erstwhile, airport in Mumbai, T1, T2, phasing closure of T1 thereafter, and the lack of supply of hotels around Navi Mumbai. What's the opening pipeline out there? Because you recently opened a premium property next to T2, Iconica.
Yes, I think, in a large market like Bombay, if you open another airport, like in Delhi also, one Jaipur airport is opening, the whole market dynamics does not shift because it takes years. And so I don't think, yes, while that is definitely a market to be in, and we are looking at, exploring possibilities of something in Navi Mumbai airport also. But it's not that these hotels will go begging or so. And in fact, with the closure of T1, some business will go to the Navi Mumbai airport, but most of the business will come to T2 So I think we are hopeful that we'll gain out of that. And so I think, these are things which, ups and downs one has to contend with. And I think wherever, there has been apprehension that this will happen, that will happen, I think industry has defied all that. And like business, whatever said and done, business in T2 area is booming with so many hotels coming up, and already operation. Business is there. So it's a very, very stable market because all those companies are not going to shift to Navi Mumbai.
Mr. Balji, I was also wondering, earlier when people used to travel, a big factor was affordability. Right now, with the growing aspirational class, or maybe even say the generation belonging to our age, they are willing to pay that slightly extra premium for the kind of experience. They need to have a proper experience. They may want to pay maybe 5,000, 10,000 rupees extra, but is that mid-tier premium segment becoming a new normal for the aspirational class, and that might end up becoming a bigger segment of the pie going forward?
It is, definitely. See, what's happened is youngsters, first of all, in India, connectivity has become fantastic. Whether Indigo or any other airline, it's very easy and rates are still very affordable. Driving distances, roads have become excellent. Like the other day, I was traveling from Jaipur to Delhi. It took me 3 hours. So it is very, very accessible. And youngsters today, at a drop of a hat with social media, you always want to also uh, fear of missing out. So if somebody's gone for a holiday somewhere, you don't want to, you definitely want to do that also. So I think this whole overall boom with Gen Z, taking over, I think the whole thing. And then, with COVID coming up, they say live for the day, don't save for the next few years. Whatever you earn, spend it up, enjoy it. You don't know whether the next day will come or not. So I think the whole psychology of the country, and there's a general euphoria in our country, whatever said and done, with the increased population, spending population, and the growth rate in our country, that we
Yes, Mr. Balji, macros are fairly well taken care of right now. We know there is an underlying tailwind. Nikhil, just a final question to you before we leave. Two trends emerging. One, the extreme premium luxury, that's doing extremely well. Boutique hotels, very high ARRs, high ADRs, very difficult to get bookings as well. And the second part is, we spoke with Puneet Chatwal. He said the gingerization of the hotel industry, where there is this emerging class coming in. They want about 250, 300 ginger hotels coming by as well. The next $1 billion for the hospitality industry, which one comes first? The gingerization or the ultra premium one?
Well, Mangalam, globally, mid-scale, upscale, and upper upscale are drive hospitality. It's not too different from the country, and I think we are at that position in the market where you'll see mid-scale, upscale, and upper upscale coming on board. I wouldn't want to give a term to it, but really mid-scale, upscale, and upscale. And if you look at the number of signings that have happened this year, as an industry, we have signed almost 50,000 keys, just about 50,000 keys. 70% of them are non-metros. And that tells you that there is not only demand there, but it's more mid-scale, upscale, and upscale. So that's where the growth is.
Mid-scale, upscale, and upper middle scale. 70% of the new keys coming in beyond metros. Thanks a lot, Mr. Balji and Nikhil, for joining in. We'll continue this discussion as we move towards the end of this year as well, and have a little more of that on how the holiday season actually fared. With that, we're out of time on this edition of Trading Hour. Stay tuned. Halftime report comes up next.